Hello, this is Mike Miller. I'm the Chief Investment Officer for Crewcial Partners. We are the Sacramento Region Community Foundation's investment advisor, and I'm here to provide a fourth quarter 2025 update regarding the investments of the foundation. We'll talk a little bit today about the core endowment and the expendable pools as well. And just to kind of get us kicked off right away, what an incredibly interesting year it was with huge levels of volatility earlier in the year related to tariffs and government policy in general, creating a very kind of bizarre set of market conditions. And a lot of this does speak ultimately to the kind of the strategy that we use here and the way we emphasize diversification, the way we tolerate volatility because we have no choice but not to, and expect to get paid though to generate the kinds of returns that the foundation and all of you require. The good news is, despite having a really rough start to the year, the endowment pool is going to finish just below 15% for the year. 14.6% is the technical number right now, but that should rise when private equity valuations from year end kick in the next month or so. That's quite a far cry from where we were back in April. But back at that point, the endowment was doing something quite remarkable, which was massively outperforming while markets were falling. And it was doing that because it owns well-valued securities, because it's diversified globally. And the strategy right now is actually, because it's such a global portfolio, is very oriented towards being successful regardless of kind of what's going on with geopolitics. And in fact, some of the shifting of capital from the US to outside the US, which has begun to occur to some degree, is beneficial to the strategy. More importantly, though, is that we're always looking for opportunities to add to areas that are out of favor, that are complicated. And sometimes there are fairly quick payoffs from that. One of the signature investments of the endowment portfolio has been an investment in something called the Barker Partnership Fund, which owns some private companies that are just soaring in value, plus owns some public stocks that did very well. So these are some of the things that contributed to the portfolio's returns, but most importantly, weren't really dependent on the economy in the short term or the actions of the current US administration or any other administration for that matter. So there's a part of this where we are at the mercy of the markets, of course. But in the long term, we're not. In the long term, it's the quality of the decisions that the foundation and its investment committee are making. It's the really unwavering dedication to diversification in a world where people frankly have lost their way on this subject. We worry a lot about the state of capital markets today, really from three perspectives. One is they're unusually concentrated in a very small number of large technology companies in the United States. Those companies tend to be involved with AI to a large degree. And we're obviously not bearish on AI per se, but we are questioning and wondering about whether or not the market certainty around what exactly will happen is in fact valid. So there's a lot of things to think about. So that's one issue. And when you own the market, when you own so many of these names and so much of your capital's in these names, that it's troubling. The second thing in the market that's really kind of got us a little concerned is how high prices are today. Things that we think about like valuation. They might be right, but they're so optimistic, and there's a dissonance between how optimistic the prices are and kind of what we see happening around us literally every day. And so that dissonance usually resolves itself, and not necessarily in a good way. And then last but not least, on the concern level, there's increasing what's the right word here? There's an increasing level of activity in the market that actually just looks like gambling. So we're seeing kind of a confluence of sports betting and market betting all happening together, and it's influencing prices. And so that kind of thing doesn't have any long-term impact on the portfolio like ours, but it does impact how the returns look sometimes. It creates opportunities at times when people sell things too much or they buy things too much. But it's a very tricky time. And I don't recall a time where we've seen as much really actually it looks like raw gambling going on. And that also was worrisome because it's frankly, it's bad for the people exercising it ultimately for their financial well-being. And it ultimately does kind of skew the markets in a way that could be very unhealthy. So with all that said, we think about a lot of things, and the foundation thinks about a lot of things when it comes to the portfolio. We're trying to generate high rates of return over long periods of time. And we've succeeded in that regard. The endowment portfolio has generated returns that are above CPI plus the spend rate over the last decade. And there's been plenty of volatility. There's been plenty of inflation along the way. And to have that kind of result is really something I know that the foundation is very pleased about. I hope you are as well.